Hey traders, welcome to Charts and Coffee. Hope everyone's doing great. Hope everyone had a relaxing, if not slightly productive weekend. It's great to see a lot of you at the Simpler Summit. We had that over in Orlando. It's actually still, the money show is still going on. So I know some of you are probably up there. Be sure to check out the Simpler Trading booth and say hi. We had a great summit over the weekend. I had a day-long discussion of the current markets. Of course, something we do here in Charts and Coffee every single morning. Always great to put faces and names together, especially when they're not necessarily our given names, right? I love when say, "Hey, this is my, I've got this nickname in the chat room, and my name's really, whatever." It's hilarious and it's awesome. So thanks everyone for making time to come out. All right, so if you take a look, I've got the Russell sitting front and center on the charts here this morning. And while intraday volatility and day to day volatility, we can have an up day, we can have a down day, the overall direction is moving lower. So what I thought I'd kick this session off with is something that we do every morning in the Sector Secrets Mastery. And it's remembering, and let me grab my drawing tools here. Let's do this. All right, here we go. So this light shaded candle, which is today's candle, is an up day, right? This is where we open the day, and currently this is where we are, right? So that's the reason it's a light colored red. It's an overall up day. The candle from Friday was this one right here, was a down day. We opened here, we closed down in here, and that represented lower lows in the day and overall a move lower. The general direction, the overall trend, which we can look at via the multi-trend at the bottom as well, that's heading lower. If I want overnight exposure, days if not weeks of exposure to the Russell, IWM, RTY, the micro RTY, if I want that kind of exposure, I'm going to look at the structure on the daily, maybe the 1 hour, 60-minute time frame, right? I'll look at that. I'll look at the structure on that time frame, but these slightly longer term time frames will give me the ability to take overnight exposure. I'm not really doing as much, and we put in a position at a level that would make sense, whether that's the daily price movement range or what have you, and we take advantage of the move lower, knowing that we have overnight exposure. And we could get into something like this on a Friday, and we have a slightly up day on Monday, right? But that's not reason to panic, because I think a lot of times traders get into a longer term time frame with a longer term time horizon. What's the difference? The difference is what's the setting of the chart versus how long we could possibly hold the trade, right? How long is that potential life cycle of the trade? We can't live in the ticks. We can't live by the up down movement. If we're trading on a daily time frame, I can't be living by the up and down movement on a 5-minute time frame. It makes no sense, right? Yet a lot of us do, because sadly we have the data. It's there to distract us. So if I'm trading longer term, shove that thing out of the way. Maybe even shove the 60-minute out of the way and just look at the nice, relatively stoic candles of the daily time frame and say, what do I really need, right? Part of that, one of the most difficult things in trading, and probably in life, is getting rid of things that we don't need anymore. Maybe we've outgrown them. Maybe they're not useful anymore, right? And that could be something as simple as a time frame. Are 5-minute time frames going to be helpful to a daily time frame setup? Nope, not at all. In fact, they're going to add a certain amount of drama that we simply don't need, right? So think about that as you start your morning. Now, if I'm thinking to myself, alternatively, the 5-minute time frame could give me some great intraday, more nimble trading opportunities, in which case I kind of really don't care about the daily as much. There are some relevant levels like the previous session close that I might want to keep an eye on. Previous session close, high, low, even the open. But for the most part, I'm sticking with the 5-minute time frame, that slice of psychology, and I'm sticking with a shorter term time horizon, meaning probably not much past lunchtime, maybe not even past 11:30 Eastern. and certainly not past the close, right? And for me, I want to start preparing for an exit on any trade that I might have had open in the morning by 3:50, 3:50 p.m. Eastern. So again, think about the life cycle of the trade as the time frame is most beneficial to it, right? If I put on a daily time frame trade, I'm not looking at the close necessarily, right? I'm not looking at what's happening intraday. So I think that's probably one of the most important things to remember. And one of the easiest ways to break this habit is to break one of the most long-standing, sort of almost accepted approaches to trading, which is multiple time frame confirmation. Multiple time frame confirmation should really be renamed. Let me find the time frame that agrees with me. Let me find the time frame that agrees with the trade that I have on. This is the fallacy of long because you're bullish. Long because you're bullish. That's proper. Bullish because you're long is where a lot of traders end up being. And multiple time frame confirmation is the gateway drug to, well, I know I took the trade on the 5 minute, but I really don't mind taking it overnight. Wink, wink. Let's take a look at the hour. Oh, look, the hour still justifies I should be long. That's the danger, right? So every morning, ask yourself, what is my ambition for this hour, for this session, for maybe this half the day? Which time frame maps to it? What's my life cycle of the trade? What's my time horizon? And that's going to really make a huge difference in how you engage what has been a very difficult October. All right, another reason October has been relatively difficult, and this happens every October. And what I mean is the tax loss harvesting of the mutual fund industry. Not all mutual funds have October year end. Many, many do. Not all, many. When you think about bond funds and most equity funds, right now, they're down year to date relative to that October to October. So while tax loss harvesting is usually reserved for the end of December, right? We wouldn't even be thinking about that for another 4 to 6 weeks for everything as we wind down the year. But remember, a lot of mutual funds have that year end in October. And while it's not always going to be this kind of reaction, this year it seems to be. This year we seem to be having a much more pronounced October reaction, year-end tax loss harvesting, since many funds are year over year down. So that's something else to think about. It's one of those things that you kind of keep in the back of your mind, but then all of a sudden you start looking at the action, saying, "Oh my gosh, we might still have a couple more days of this." All right, so that's just another thing to keep in mind as we wind down the month of October. Tomorrow's the last trading day of the month, and we move on to November. By the way, by the time we get to November 1, here comes FOMC. We have the FOMC meeting, monetary policy, so the statement and the press conference. And for traders looking for a cap on the dollar and a cap on yields and equities starting to benefit from potentially lower yields going forward the next 6 to 7 months, this is going to be the event, or this meeting is going to be when the FOMC, if they want to, can clarify that messaging. We don't know what they're going to do, but if they want to clarify the fact that they're not going to hike in December, it's not even factored in any meaningful way, and that we could see rate cuts maybe early summer rather than late summer, this would be the time for the Federal Reserve to begin to at least allude to that. All right. So keep an eye on things like the Euro 6E. Keep an eye on things like the bond market, ZBN, even the ZN. Keep an eye on those and see if they respond with lower dollar, higher ZN, higher ZB. All right, gang. So as always, questions are the best part of this show. So let's go ahead and take a peek. Apple event tonight, unveiling a new Mac. And, it's going to be interesting. We take a look at Apple and we see where it is. Apple, like Tesla, are two of the weaker Magnificent Seven. So Magnificent Seven, Apple, Microsoft. Let me move this 5-minute chart over. Apple, Microsoft, Meta, Google. When we take a look at what is most bullish in the equity markets, it's actually it's a small number of that magnificent seven. Not all seven of them are above the 200 exponential moving average. And not all seven of them are at levels that I would consider buyable. But this week, considering non-farm payroll, we have ISM data coming out, which is more of an inflation metric. We've got non-farm FOMC jolts. We have the jolts, which I would say is only second in importance in terms of employment picture to the non-farm. A lot of data, a lot of macroeconomic events and data. If some of the relative outperformers in tech are going to make a stand at their 200, this would be the week, right? This would absolutely be the week. We've got the bulk of tech earnings behind us. And if they're going to say, all right, this is what earnings were doing, this is what yields are doing, this is what the Federal Reserve is messaging, this is going to be a big week as we end October and move into November, that those 200 period exponential moving averages have got to hold. So I'm already imagining what Sunday's top tier outlook discussion, we come up to that this coming weekend. What are we going to be saying about this environment? Does the Federal Reserve just drop the hammer on these levels, or do we start to see some stability in those relative outperformers? And by the way, the Dow is not a relative outperformer. The S&P is not a relative outperformer. The Russell is not a relative outperformer. Neither are healthcare, industrials, transports, financials, regional banks. There's a bearish case, but it's mostly compartmentalized into Russell, Dow, and even S&P. Tech, relatively speaking, to those sectors is where the resilience is, and that benefits the NASDAQ the most, right? Which, by the way, the NASDAQ is the only one of those four indices that's still above the 200, that's still in a neutral, not downtrending structure. All right. So yeah, let's see what that Apple event does. And why does that matter? Apple has such massive weighting across the Dow, the S&P, and the NASDAQ in the XLK. So if Apple can benefit from that news, but by the way, the problem with product announcements are we already know when that announcement's going to happen. We already know, for the most part, what those products are. And just like any of the worldwide developer conferences, the WWDC, and any kind of announcement of a new iPhone, that is usually a buy the rumor, sell the news. So this is going to be a pretty tough reason to say Apple should continue to rally on that announcement alone. All right. Next up is BLP asks, how do you choose a stop loss? So there's a few main things, BLP. One, what's the strategy? Every strategy has a validity for why that entry was something we were willing to do in the first place. All right. After that, we have to think about risk to our account, right? Even before we think about whether or not we should take this trade, we have to ask ourselves, if wrong, because that's really the only thing we can control. If wrong, how much risk do I want to present to my account? That's going to determine position size, which is really the same conversation, or part of the same conversation or formula, if you will, to stop losses, right? So once you determine those things, BLP, that's what those, so there's no blanket answer, I should say. There's no, hey, this is what you should place your stop loss at. I wish that existed. It doesn't. What we want to, and by the way, max debit is not a stop loss, although that seems to be a very popular way to go about managing options trades. I've likened max debit stop losses to saying I smashed into a brick wall. That's the same thing as hitting the brakes, right? I mean, the car stopped. So please remember, we always want to think about stop losses really at the root of it. How much risk are we presenting to our account? All right, Christian asks, a new trader on the Mastery. Awesome. How long would I say is enough time to learn how to day trade? Oh, okay. So Christian, this is what I've experienced from members, right? So having been teaching now for over 2 decades and having been in the Sector Secrets Mastery now for a number of years, a couple of things that I've observed. First day, even first week, is going to be overwhelming. What is that saying? Drinking through a fire hose? It's going to be overwhelming. The lingo is going to be, trading lingo for the most part, but the lingo might be a little different when I start talking about break-even stops and targets and aggro, scaling in, scaling out, right? So the first week is really going to be as if neither one of us speak Spanish, and I drop us in Barcelona. And we're going to say, gosh, I know how to ask for the bathroom and maybe order a beer, and that's the end of my, right? Uh, we're not going to be fluent. So the first week is just a little bit of fluency. And some traders pick it up in less than a week. I'd say the first week is just going to be getting your bearings. You're in a brand new country, and you're just learning some of the important words to be able to navigate through it. So fluency. The second week, now the lingo is starting to make sense. You understand the meaning associated with the words, and you're starting to get a little bit more comfortable with the pace, right? And so the second week, you're going to start to see that the lingo and the actions are starting to make a little bit more sense. And the pieces start coming together, but there's still a slight degree of overwhelm. By the third week, so you're about 21 days in, you're going to have seen me use the same process, the same words, the same pace for at that point 3 weeks. And I would say right around that 3-week mark, it's going to start to make sense, right? And I want to mention this as well. Trading is the only, and I think our industry is guilty of this. Trading, teaching how to trade. Trading is the only industry where we say start tomorrow, right? We watch these commercials. The guy's on the yacht. He's got that brokerage. I mean, he's ready to go, or she's ready to go, right? If you want to be a pilot, if you want to be a doctor, if you want to be a lawyer, if you want to be an engineer, my father was an engineer. If pick the career, you've got to put in the hours. A lot of times you've got to put in the hours just for the certification or the degree or whatever, right? To pass the test. Every other industry has a certain amount of time. And so it seems that trading is one of those things where, gosh, I'm here. It's time to trade. Put in those hours. They're going to be self-imposed. You're kind of doing this self-imposed certification, if you will, in many ways. But put in the hours, get the fluency, get familiar with the pace, and then at that point is trading very learnable. It's something that you can do on your own in terms of, oh, I understand the trade. I can push the button. I can take the alert you're sending, Raghee. Yeah, I think those are all very reasonable things. So that's the way I look at that. It doesn't matter if it's day trading, Christian. It doesn't matter if it's swing trading. I would say day trading, the pace is probably going to be the most important, the pace. Yeah. All right. Next up is a question about crude oil. I realized I just blocked my, let's see here. There we go. Just going to take a look at crude. Crude, I wouldn't say it's weak, Ren. I mean, again, let's go back to what we talked about at the onset of the chat. Well, weak based on what, right? We're not really going anywhere in the daily, are we? And so this is where, I do tell my traders the same thing I tell myself. If I'm looking at weakness based on what? Which time frame? What is the lens that you're looking at the symbol through, right? If you're looking at this crude oil symbol, what is a lens? I wouldn't say crude is weak. I wouldn't say it's strong. It's an inside day. It's been stuck in a range for the previous 3 sessions. We still remain in that range. If I take that opinion to say a 1 hour for a short-term swing, it's actually nearly oversold, and it could be nearing a buy zone, right? So whenever I look at this, Ren, whatever your prism is, whatever that lens is, for me, I'm going to look at it from the standpoint of which time frame, right? Do I want to engage, and what's the structure on that time frame? Because the daily could be heading lower. Let's take the Russell, for example. The Russell's overall in a downtrend, but I could have an up day, hence day trade, in the Russell, while the overall index day after day after day, week after week is overall in a downtrend. So that selection of the time frame is so important. All right. Okay, gang. And just like that, I am out of time. But thank you as always for all the questions. Bring them back tomorrow. Get them in early so I can get to them. And I start, if you want to put your questions before we start the show, totally fine. I just take them one by one. As always, gang. As always, great to see you all. And I'll see you tomorrow, same time, same station. Be good to each other.